Glass shatters. Shouting echoes. Flashbulbs pop. The Treasury Secretary storms out of a closed-door press briefing. His tie askew, papers in hand, face red. Scott Bessent isn't walking. He's charging. Cameras catch just 5 words. We sent the letters. 100. And just like that, Washington goes silent. 100 countries issued what Bessent calls tariff letters. But critics say these weren't letters. They were ultimatums, with no dialogue or diplomacy. Just an industrialized threat. Renegotiate trade under U.S. terms, or face tariff rates not seen since the 1930s. The letters, according to Bessent, will boomerang tariff rates back to April levels, some as high as 50%. But here's where the first contradiction lands. None of these countries had agreed to talks in the first place. Vietnam, Korea, and Mexico, yes, reliant on U.S. exports. But a majority of recipients, silent. No replies, no outreach, no public concern. The implication? Either they don't believe Trump will follow through, or they've already moved on. That silence has teeth. According to Bloomberg's global trade trackers, more than 63 countries on Bessent's list now do more annual volume with China or India than with the U.S. That's not politics, it's arithmetic. So why would they negotiate a lopsided bilateral with Washington when they're already hooked into lower tariff corridors via BRICS? This isn't defiance, it's indifference. But here's what makes the timing especially volatile. Trump delayed the tariff trigger. Again. July 7th was the original deadline, then August 1st. Now Bessent calls it a signal, not a deadline. Yet markets aren't fooled. The S&P 500 dropped 2.1% intraday the moment Bessent's remarks hit Bloomberg Terminal. Investors weren't reacting to the tariffs themselves. They were reacting to the chaos around them. That chaos includes a $3.4 trillion tax expansion, passed just weeks prior, fueling fears of debt-driven inflation baked into policy. There's no fixed line, only warnings that don't land, and trade partners who don't answer the phone. Meanwhile, a second front opens. BRICS. Trump's newest directive imposes an automatic 10% penalty tariff on any nation aligned with anti-American BRICS policy. But, the term anti-American isn't actually defined. Is it de-dollarization, joint infrastructure, multilateral settlements? Under that logic, Germany, a NATO ally, could be penalized for conducting RMB-settled trade with China. Brazil could even face double duties for participating in a BRICS reserve asset program. That program, designed to settle trade in commodities like oil or lithium using a shared non-dollar instrument, hasn't even launched yet. This isn't a line in the sand. It's a moving target painted on the backs of anyone who trades outside the dollar. And yet, Trump's pressure campaign reveals a deeper irony. The United States helped write the global trading order it now seeks to punish. The WTO, the IMF, SWIFT, even bilateral free trade constructs. These were built, funded, and policed by Washington for decades. Now, with BRICS forming a separate financial bloc, one rooted in non-dollar settlements and raw commodity trades, Washington's own framework is being turned against it. The same interdependence it once championed now becomes its constraint. Let's think deeply for a moment, because what Bessent calls a trade strategy is starting to look more like a containment doctrine with no boundaries. This isn't diplomacy. This is a shotgun wedding with a ticking clock and no groom in sight. Consider the raw numbers. Back in 2000, the G7 accounted for 70% of global GDP. Today, it's just under 43%. And BRICS? They've climbed from 18% to 34%, and that number is still rising. China alone is projected, by the IMF, to make up 19% of global GDP by 2029. Now, let's factor in those pending BRICS expansions, like Indonesia, Egypt, and Saudi Arabia. If they're formally admitted by 2026, the bloc could control over 46% of the world's productive capacity, and more than half its critical mineral output. So what leverage does a tariff letter really carry in that kind of landscape? Still, Washington insists its size and consumer market offer unmatched leverage. But, leverage cuts both ways. U.S. importers rely on $3.1 trillion worth of foreign goods every year, according to U.S. Census Bureau data. China alone, despite all those ongoing tariff frictions, remains the number one source of U.S. electronics, batteries, pharmaceuticals, and auto components. Sure, Bessent's tariffs may squeeze foreign exporters, but U.S. producers will bleed right alongside them. through higher input costs, fractured logistics, and retaliatory strikes. Retaliation is no longer hypothetical. In 2024 alone, China BRICS trade hit 4.6 trillion yuan, or about $650 billion US dollars, a 5.2% year-on-year increase, according to China's Ministry of Commerce. And that's despite recession signals in Europe, rate hikes in the US, and a global downturn in demand. So just imagine the effect of even mild trade realignment under penalty tariffs. With a single executive order, Trump could force U.S. allies to reroute supply chains toward BRICS, a pivot that once made probably won't reverse. And it's already happening. According to Reuters, more than 37 countries have formalized RMB settlement pathways since 2023. The Gulf Cooperation Council just authorized yuan-based crude contracts. Brazil and Argentina now clear over 40% of trade with China outside of the US dollar. This isn't theory, it's rollout. The result? A marginal, but persistent decline in dollar demand. And with it, a weakening Treasury bid. Let's test that claim. Bloomberg data shows that foreign purchases of U.S. Treasuries fell by $289 billion in the last 12 months. The largest buyers? BRICS and their top partners. China's holdings alone dropped by $102 billion, its fastest drawdown since 2016. Why? Because with less trade in dollars, fewer dollars need recycling into bonds. Treasury demand collapses. U.S. borrowing costs rise. And Bessent's boomerang begins to hit home. Beijing, however, isn't just divesting. It's accumulating gold. The People's Bank of China added 70,000 troy ounces in June alone, bringing its 8-month total to over 34.2 metric tons per official disclosures. This isn't about yield. It's about trust. Gold doesn't carry U.S. political risk, sanctions risk, or debt ceiling theatrics. And that's precisely what makes it attractive to BRICS. Irony alert. A metal Washington once demonetized is now the asset Beijing weaponizes. Even Europe's moving. In a rare shift, a German church pension fund allocated $50 million to a Hong Kong-based China equity fund, according to the Financial Times. Why? Exposure to high-growth, undervalued Chinese tech and industrials, but the symbolic weight is heavier. This is a NATO-aligned entity parking funds in a market Washington considers adversarial. So while Bessent crafts tariff deadlines, BRICS is quietly absorbing Western capital. So markets are noticing. Year-to-date, the Hang Seng Index is up 21.3%. The S&P 500 just 6.7%. Now, this doesn't mean Wall Street is collapsing, but it does suggest that capital is diversifying. Traders are beginning to price in long-term instability in U.S. fiscal and trade policy. And, when volatility becomes structural, yield isn't enough. Investors chase systems, not spikes. That's what makes the next move by China even more provocative. According to Bloomberg, Beijing is now weighing an expansion of the southbound bond connect, allowing up to 1 trillion yuan in capital flow to foreign debt markets. That's roughly $140 billion USD in new outbound potential. This would partially unlock capital controls for China's institutional investors, letting them buy euro bonds, US corporate paper, even treasuries. On the surface, this might seem dollar-friendly, but in practice, it's Wall Street displacement. The goal, according to PBOC sources, is reciprocal flow. China wants to build a mature financial system in Hong Kong, one that attracts inbound capital while granting outbound access. But that can only work if investors no longer need Wall Street. And with Hong Kong Stock Exchange preparing to list more sovereign BRICS bonds, the ecosystem is rapidly evolving into an independent platform, one that can grow without the US, and eventually against it. Meanwhile, Trump's fiscal strategy risks triggering a feedback loop. His most recent tax bill added $3.4 trillion to the US deficit, per the Congressional Budget Office. At the same time, inflation projections jumped by 1.7 percentage points for 2026. But, the distributional effects may be more politically toxic than economic. Data from the Joint Committee on Taxation shows the top 20% gain 2.3% in annual income under the new law. The bottom 20% lose 2.3%. So as tariffs drive prices up, the purchasing power of the bottom collapses, just as the wealthy move assets offshore. So what happens when the middle class can't consume? Growth stalls, retail freezes, small business investment declines. This isn't just theory, it's the 1970s playbook with new actors. Layer in tariff-driven inflation of 15 to 20%, as projected by the Peterson Institute if August rates take effect, and the pressure on household budgets could become unsustainable. And yet the BRICS bloc, it continues expanding credit, softening rates, and subsidizing trade. The contradiction is sharp. The US tightens, the BRICS accommodate. And the final twist. This entire breakdown may have been built in the same lab that once funded globalization. The US exported the very system BRICS now uses to unseat it. Trade corridors, digital payment rails, dollar alternatives, even infrastructure templates. It's not a coup. It's a remix. And if the US continues to threaten rather than compete, it won't be tariffs that isolate it. It'll be gravity. Will BRICS back down? Will Trump recalibrate? Or are we watching the final fracture of the old trade world? Let us know in the comments. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.